Sandy Pomeroy, one stock you like at the Neuberger Berman Equity Income Fund is Douglas Emmett. Now this REIT is up over 20% year to date, pays a nice 2.3% dividend yield. They've got property in California and Hawaii, very nice places, but it's trading at about 20 times next year's earnings. A lot of the REITs are getting pricey, so why hold Douglas Emmett?
Well, REITs have always been a core part of the equity income strategy. The objective of the strategy is to deliver 7 to 9% type returns, sort of compounded over an investment cycle, with half coming from income and half coming from appreciation. So REITs have fit very nicely into that strategy. Douglas Emmett, we think, is a little bit unique because at the end of the day, even though REITs have had a great run over the last year or so, we feel that really REITs are priced off of supply and demand. And LA supply is super, super tight. This company dominates LA office, and they have some residential, as you mentioned, both in LA and also a bit in Hawaii. But because the supply and demand characteristics of their markets are so tight, we think that they've got terrific net operating income growth here going forward. And we think it makes it unique within the office space, in the U.S. So yeah, we like it a lot still.
All right, you also like Qualcomm. They're having a great year. Stocks up almost 25%. They had a great third quarter earnings beat not too long ago. Stock got over 60, but what's it going to take to get this stock over 70?
Well, so this has been a really bad stock for the last sort of 12 to 18 months. If you look back, it hovered, well above 70 from, most of its life. And it's just been as there have been concerns about getting paid out of all these cell phone manufacturers in China. That's slowly but surely getting resolved, and they're getting paid the royalties that they're really due for the IP that they've provided for those phones. Now the concerns have been all about Apple and whether the new phone is going to be anything that people actually want to buy. The revenue model at Qualcomm is that they get paid a percentage of the cell phone cost. So if you buy an iPhone for, call it $800, they get a percentage of that fee. So the more that prices go up and the more handsets that sell, they get paid. But what people underappreciate about Qualcomm is, first of all, the balance sheet's super strong. They have an amazing dividend yield for the quality of company it is. And they've got IP that we think is really underappreciated. So we think that just as they bring out this IP and are able to commercialize more and more of it, that you will actually see this company grow their revenue, grow their dividend, and the balance sheet can support any kind of bumpiness along the way.
All right, and you are bullish on Union Pacific. Now that stock, the railroad's up about 20% year to date, but volumes are down. And it's not just coal. So why do you want to own a stock when volumes are going down?
Yeah, there's no question that the U.S. has been in a manufacturing recession here for the last, several quarters. We think we're getting to the bottom of it. You're beginning to cycle the worst of those volume declines. Coal is one of these businesses that's likely to stay lousy for a long time because it's being replaced by natural gas, by renewables, et cetera, et cetera. But, the more the trade takes place, Union Pacific carries that. Corn now has hit all-time lows, and the lower that corn goes, the more exports we tend to do. And then if we were to ever have a recovery in sort of general manufacturing, housing, or even in the energy patch, Union Pacific is going to be a huge beneficiary of that. There's a huge amount of leverage that they have with rising volumes and pricing, which they've been able to get. And we think that dividend is going to be able to grow over time as well.
All right, maybe they can ship things in boxes because you like International Paper. They beat on the top and bottom lines in their second quarter. Stock's doing fairly well this year. It's up, I guess, around 20% or so. So tell me about International Paper. What takes this one higher?
Yeah, so I would also like to add that with our equity income fund, that we have utilities and REITs that make up a good portion of the fund, and we like to look for things that offset some of that macro risk that would be associated with rising interest rates. By having companies like International Paper, like Union Pacific, these companies benefit as the economy begins to take off. And if the Fed begins raising rates because the economy is doing better, these stocks are going to do better and help offset some of that interest rate sensitivity in some other parts of the portfolio. So we think that this is a natural portfolio construction fit for us. But what's unique about IP is that whole box environment has changed. The industry's consolidated down to 3 players, so it's really an oligopoly these days. We've seen the capital allocation decisions improve since the global financial crisis. And probably first and foremost that we like is there's a tailwind because of Amazon and all the e-commerce that's going on. The e-commerce industry requires a better, stronger box because consumers don't want to get a box that's got a hole in it or has been damaged. So in order to use a better box, you have to use better fiber, and that plays right into Union Pacific's strong suit. And we think that that company with a 4% yield can continue to grow that dividend over time as well.
All right, well, thanks a lot, Sandy.
Sure, thank you.
And thank you for watching The Street.